Hello and welcome to Big Deal. In Finance Minister's package and reforms that have been announced, power sector at least optically looks like one of the biggest beneficiaries in terms of giving liquidity to the DISCOMs, or else even the privatization of DISCOMs in union territories and some of the other aspects. But is it really going to solve for the immediate crisis situation for the power sector? Or is it going to make it unsustainable for the power sector in terms of the cash crunch that the sector is seeing? Will it be a compelling investment for the investors? To solve that particular question, we have with us a power-packed lineup from the power sector. We have with us Ramesh Subramanyam of Tata Power, and also joining us will be Pratik Agarwal, Sterlite Power, from the transmission aspect of power sector, and from the renewable space there's going to be Rahul Munjal, who's joining us from Hero Future Energies. Gentlemen, so good to have you on CNBC TV 18. Starting with you, Ramesh Subramanyam, of course, you've been in the industry for such a long time, and we know that DISCOM liquidity is one of the biggest problems. While the government has doled out liquidity worth about 90,000 odd crore rupees, is it going to solve for all the problems?
Nisha, are you able to hear me?
Yes, we can hear you. Go ahead.
Okay, thank you. No, I think the 90,000 crore package is essentially meant for filling up the working capital gap that the DISCOMs are already facing, and an equivalent amount is actually payable to the GENCOs across the country. And if you look at it, really, this breakdown, it's 50,000 crore out of this is actually owed to the PSUs themselves, because it all state-owned GENCOs. So it's a working capital correction within the government system, and also IPPs are about 35% of the total outstanding. And I think it's a good idea to introduce this at this point of time, because otherwise you could have this entire value chain stuck because of lack of liquidity. But the interesting conditions attached to it really are something which we have to see how many states qualify. And therefore we would wait how many finally kind of opt for this, because there are a few conditions like they have to be also having no overdues, and they have to be regular accounts, and they have to demonstrate receivables. So while it's all practically possible, I think the states, because they have to be guaranteed by the state, it's going to be a challenge, because the state governments have to check their finances before they approve it.
Right. So execution could be a challenge is what you're saying. And of course, more borrowings by the states is also linked to the power sector reforms. But we'll have to see how much of the liquidity issue can be really solved. Pratik Agarwal, what do you think about the execution aspect and also the demand scenario? Where do we stand when it comes to the power demand at the moment?
So thank you, Nisha, for having me on the show. First, let me share some good news with the audience, and this is something we've been tracking on a daily basis. We found that as of yesterday, 25th May, power demand is already back at 90% of the normal demand that was there exactly a year ago on 25th May 2019. This is quite surprising, I'm sure, for everyone, because we know that a large part of the economy is still shut down, which can only mean that the residential consumption that is happening from work from home is sort of replacing a lot of the commercial and SME consumption that is obviously not there, or there at a subdued level. So that is one interesting statistic which could point in the direction that if power consumption can come back up to normal levels in the months of June, and then once the billing cycle can restart, that could mean that the cash flow cycle could once again start in the power sector. Now, just to comment on the package.
All right, Pratik, before you go to the package bit, Pratik, I'd like to, I don't want to mar your enthusiasm on the power consumption, but some of the figures that I also got from CEA do show that when you look at month-on-month basis, yes, there is an uptick and there is consumption and demand coming back. But when you really compare it to the May last year period, it is still down by 12% as far as the numbers on the CEA website are concerned. So my question would be, in FY20, there was a power demand growth of only 1.5% in the last fiscal. Given that this particular year has already seen a washout in the first segment, first quarter, and going forward, there could be stress in the system and therefore the demand can take a beating. A demand contraction could be expected or not?
Oh, short answer, Nisha, is yes. I think everybody is expecting a demand contraction. The question is what magnitude? Is it the 30-40%, which was the worst nightmare people had thought? I think the answer is clearly no. A 5% at a full year basis and a 12% for first quarter is what the numbers are telling us, which I think is digestible compared to what we thought it might be.
Right. All right. We'll talk about the financial package also in a bit. But Rahul Munjal, looking at the present situation, looks like your side of the power sector is much more rosy than what the conventional thermal power is. And especially after the latest contract that one of your peer companies or rival companies, Renew Energy, has got in terms of the round-the-clock power. What do you have to say about that, and what big breakthrough is it when it comes to the renewable energy prospects in the country?
Yeah, so there are two parts. Let me just touch upon what Prateek was saying. The power demand in India is back to pre-COVID levels, but from last year, May, June, it's been a very, very hot month. So you would understand the consumption of energy inside homes is a lot more. And about 9% of consumption in India is for commercial, which I don't think will come on in a hurry. But I agree with him. Overall, we will see a 5%, maybe a 7% demand drop. And for this quarter or this period, we will have a 20-25% demand drop. Having said that, moving on to renewables. So of the demand, electricity demand that's dropped, it's affected coal and it's affected renewables. Fortunately for renewables, it's not affected us so much because we have a must-run status. Because we can only produce wind energy when wind comes. We can only produce solar energy when solar comes or when sun comes. So at the time when there is sun and wind, we cannot back down. So because we enjoy a must-run status, we've not backed down a lot in many of the states. Thereby, we've been able to produce to almost what our capability was. And I must say, while there was some back down, but it wasn't more than what you would generally experience any other month, pre-COVID, post-COVID, regardless. So that's on the power demand and generation part. Secondly, you spoke about RTC. There were two tenders very recently by SECI. One was about RTC, which was round-the-clock power. The other one was on peak demand. And both of these are, in my opinion, renewables 2.0. You made renewable energy because it's intermittent. You made it a little smarter because now when you say round the clock, you expect your wind and your solar plant. So it could be a hybrid. It could be a hybrid along with storage. It could be wind, solar and storage together. So you could engineer the project in such a way that when India needs the demand most, so it could be a peak power demand project, or it could be a round the clock power project. So in a round the clock, you will give power about 80% of the times, whereas in peak power, you will give power between 5 and 7 p.m. Roughly. So I think this is the way of wind and solar going forward. We will have these hybrid, highly engineered kind of bids coming out.
Right. While Rahul, the prices look now quite competitive compared to thermal, but I also must say that with every year the escalation is accounted for, and also there is a merchant power component attached to that, which of course depends upon the demand and also market forces when it comes to the pricing. So that is another aspect before we totally write down the thermal power situation in the country. But coming back to Ramesh Subramanyam, given all this situation right now, do you think there will be any fresh investments in thermal power? And looking at the financials and the cash flow situation, while moratorium helps, but then you still will have to pay that interest and interest upon interest after the 6 months period.
Yeah, Nisha, to your first question, I think thermal, for the near term, there will be no greenfield development, that's for sure. Clearly because there is no one writing a 25-year contract for thermal. And as it is, funding for thermal projects is also becoming a challenge. Having said that, there will be a lot of churn within the existing assets because there's a lot of consolidation that's happening in the thermal sector. And that, is one activity which will keep on going. And probably after 4 or 5 years, or after a dry spell for the thermal new projects, I'm sure that there will be another period when economic activity picks up. There will be a fresh demand. And remember that, one thermal plant is equivalent to about 3 renewable plants in terms of sheer PLF. So therefore, we might see a spurt a little bit, but that would probably be taken care of by the NTPCs of the world because private sector would be very difficult to get convinced on investing. Your second question was on moratorium. I think the moratorium, yes, it is just a postponement. It's more a liquidity support for the fact that on the other hand, the customers are not paying, and therefore it helps you to pace out. But yes, you cannot run away for long because ultimately you'll have to pay those dues sooner or later along with interest. So it's more I would say today, if suddenly someone runs into a working capital situation, it's not very easy to get limits on a stressed asset or a semi-stressed asset in thermal sector. So it's a good way to at least keep afloat temporarily people facing liquidity issues.
All right, keep afloat at least temporarily is what the word is from Tata Power. But as far as the financial health of the overall power sector is concerned, we will continue that particular discussion right after this short break on this Power Packed lineup. Stay tuned.
In these unprecedented times, as markets turn volatile and investor fears increase, CNBC TV 18 helps investors create a pandemic-proof portfolio. Meet the Nawab of Dalal Street as he gets you insights from the finest financial minds.
A lot of the paradigms we thought were very reliable have gone busted.
Debt and credit is the best asset class at this point of time.
You always have stocks that are outperforming into the peak.
Wizards of Dalal Street.
Welcome back. We are discussing the power sector and whether or not the government's reforms are going to give that immediate relief that is required to sustain at least in this financial year for the power sector. Pratik Agarwal, coming to you, there's an important point that was raised by Ramesh Subramanyam on the working capital and the cash flow requirement of the companies. As a developer for the transmission companies as well, don't you think that your working capital cycles is also going to extend in this particular cash flow situation? And on the other hand, the cost of credit is going down, but probably the cash flow situation will mitigate that for power sector companies like yourself and the capital intensive sectors like yourself.
Yes, Nisha. So for the first, I would say 8 weeks of the lockdown, or the first 6 to 8 weeks of the lockdown, definitely there was a complete stoppage of the cycle across the sector, where I don't think any bills were being raised right till the consumer level or at the wholesale level. Now, since then, things have improved quite a lot, and I think the government has done a good job in terms of implementing some form of e-billing in various parts of the sector. So that's point number one. Point number two, this 90,000 crores, as and when it does flow through, is, as Mr. Subramanyam said, is equal to the entire outstanding, at least to Gencos. So if that does come through, then you're looking at a one-shot, I call it a steroid in the arm of the patient. Of course, the patient is in ICU, and we have to think about temporary measures to keep the patient alive. And I think this is a good way to do that. But I'll talk about later what really the government needs to do in terms of long-term survival and profitability of the DISCOMs. And there are some very good promising measures there. Coming to transmission, I must say that transmission has been somewhat removed from this working capital issues because transmission represents a very tiny fraction of the overall payables by distribution and generation companies. And the central government is in charge of all collections and disbursement. So by and large, it has been removed. And whatever delays we saw in the months of March and April, we think will get corrected by perhaps June or middle of July.
Right. As far as the financials of the renewable is concerned, let me focus on that as well. So Rahul, throw more light. A lot of companies were really focusing on the IPO fund to really take care of the deleveraging process. Now that the IPO dream has totally been ruptured in a situation like this, how does one handle the financials? And also a lot of renewable energy assets, even though the prospects, the long-term prospects look much better right now, are up on sale.
I think to say a lot of renewable energy assets are up on sale is like saying a lot of businesses are globally, infrastructure or otherwise on sale, which is true. We are in the middle of a crisis. In the middle of a crisis, everything is always for sale. Everybody wants to look for liquidity and everybody wants to conserve cash as much as possible. So I don't know if it's especially worse than it was or it's worse than any other sector. As far as IPO goes, there were very few people. There were very few companies who were looking for an IPO. More than IPO, there were a lot of people who did US dollar bonds. And US dollar bonds was a very good way to fund renewable energy or other such infrastructure assets. In the short run, emerging market risk premium for these dollar bonds have gone up very, very high. So that is one capital form which is dried up for a very short run. The volatility there is increased to an extent where I don't think it will make sense to hit those markets for the next couple of months, maybe the next 2, maybe even 4 months. So one has to see how will one fund or even project finance these projects. So as far as equity goes, I think there are some extremely big players in the industry who have backings of very large companies or large private equity backing. So they will get the equity in. Equity will not be a problem. It will be a problem of debt. How do you finance these? And while the banks might have liquidity, their interest to finance them and at the price they would like to finance them might not be very feasible for the prices at which these projects have been won. So there might be a mismatch between the debt pricing going forward while the RBI goes on lowering its price to the banks. But what actually comes from the banks to the private sector like us is very, very different. We've only seen the prices going up rather than even staying stagnant or even going down.
A very important point you raised, Rahul. Of course, liquidity may not be a problem. Interest rates may be prima facie low from the RBI's point of view, but on ground, it has not come down and the money is not getting dispersed by the banks, and especially for the power sector, it needs to be seen. But Ramesh Subramanyam, looking at the overall sector right now, thermal power projects have been in distress. Some of them were on sale. JSW Energy just recently put on hold its acquisition of the Odisha unit of GMR. So looking at this situation in the absence of IBC, cash conservation theme playing out everywhere, what happens to the stressed thermal assets then?
Well, there are two types of thermal assets today in the country. One where the assets are generating enough EBITDA to pay their debt, but due to the tariff not being good enough, they're less profitable and the promoters want to get out of it. And then there is a whole bunch of other assets where the capacities are untied or they don't have fuel tie-up, and as a result, their fundamental ability to generate EBITDA to meet debt service is in deep stress. The first category, can still survive. The second category, in absence of people to put up capital to buy those assets, and more importantly, those who are buying into that second category will have to have the staying power to wait for the demand pickup to happen till the untied capacity gets tied up. Now, that's a big challenge as it is, thermal capital
Right.
is drying up big.
That's a big challenge, Ramesh.
Yeah.
All right, thermal
So
capital is drying up big time, but from your own stable, from Tata Power, you have announced that you are going to monetize and restructure the renewable side, which may still have buyers, which may still have investors, to reduce your debt levels from about 48,000 odd crore rupees to 25,000 odd crore rupees. So that aspect is also going to be turning out to be an important piece.
Well, today what is happening is that debt is itself a tough word in the market. Therefore, every company, not just ours, is trying to stay trim on debt. And these are various ways. And fortunately, renewables also not only is right now a very good, I would say, investment destination for funds and pension funds and many strategic investors, but more importantly, vehicles like a platform or an InvIT also make it attractive for yield return investors to come in. So just like others, we are just like Prateek has done. I think we are also trying to see whether we could do something of that sort. But these are things in process. But yes, reducing debt is a top priority for us.
All right. So InvITs. Yes, so deleveraging an important priority, and thank God InvIT has struck us and has come to the market much before COVID struck us. But Prateek, quickly, some suggestions required for the power sector at the moment.
Okay, so I think we talked about the short-term measures. Let's talk about the long-term measures quickly. I think the government has made 3 clear priorities as far as long-term DISCOM reform is concerned. And if they follow through with this, I think this could be the 91 moment for the power sector in India. Those 3 priorities are bringing the losses down to 15%, doing direct benefit transfer for subsidies rather than letting the DISCOM pick up the check. And third is open access, so that high capacity consumers can actually really buy direct power from the producer. These 3 are the critical ones. I think the big bang reform, what we have seen in the speech of the finance minister, is in sub-licensee of DISCOMs as well as DISCOM privatization in the union territories. Now, we have on the panel Ramesh, who himself has seen incredible improvement of efficiencies.
Prateek. Right. Prateek, so DISCOM privatization has been the clarion call for a very long time. Separation of carriage and content has been a clarion call for a very long time, but it's also a political subject. Very quickly, Ramesh, we have just 30 seconds to wrap up, but where do you see this going? Does Union Territories DISCOM privatization give you any hope, or is it just too political to be executed on ground?
No, it's extremely doable. And it's a very smart thing to do, to first attempt the union territories which are in state central control. That will, in our view, also set the tone and set an example for the states to follow. So if executed well, this could be a very good change starting point.
And Prateek mentioned a few other DBT and some of the other aspects which could come in new tariff policy, as well as also coal mining policy, which has also been liberalized. Ramesh, very quickly, is that going to immediately impact the power sector and help in the crisis situation right now?
No, remember, these are policy decisions. They will take a while to implement, but some of the measures are very, very powerful. For example, the contract dispute resolution mechanism in the draft electricity bill, then the prevention of a clear statement on regulatory assets, direct benefit transfer and open access, grant procedures, and cross-subsidy reduction. They are all, if they are built into the policy making, then it's something which is left today to the regulator to do. But if it is put in the policy and driven as a matter of law, then it makes a lot of difference. I see that as a very big positive.
Right. All right, Ramesh, Prateek, as well as Rahul, for joining us on this discussion. Of course, this can just go on and on. The aspects to be discussed on power sector are quite a few. Government has tried to address a few of the issues, but of course, cash flow situation will remain tight and a lot more needs to be done. Probably the investor community will have to pitch in if it's going to be a compelling investment destination. With that, it's a wrap on Big Deal. Thanks so much for tuning in.
Brought to you by Fortune Chakki Fresh Atta, Soft Roti Ka Wada, and SMC Money Wise, Be Wise.
Be ready for a new experience.